So the Nigerian asset management market is forecast to hit about 3.5 trillion naira in total value by the end of 2024, and that, according to a report released earlier, last year by Augusto and Co, a Nigerian rating agency. According to Augusto, Nigeria is one of the largest managed funds in Africa after South Africa and Morocco, with a compound annual growth rate (CAGR) of 20% between 2017 and 2021, and despite a contraction of 5% 2 years ago. Joining us to discuss further as far as Nigeria's managed funds, Robert Omotunde, Chief Investment Officer at AfriInvest Asset Management. Robert, you're very welcome. Good to have you, with us in the studio. Good to see you again. Can you give me an overview of how your, managed funds have performed so far?
Well, it's a space that is growing, as you had earlier mentioned in your introductory report. And the growth is, born out of the desire by most investors to get something extra in terms of return on their investment. Rather than just putting your money in the, your savings current account, you want to see better uses for those funds. And so all different products that are coming up within the space, targeting different asset classes, are now springing up mostly from most investment management firms and what we call fintech, financial technology platforms,
yes,
that are offering most of those products. And because we are in a very high inflationary environment, you tend to see that a lot of investors are interested in getting something better, in the drive to beat inflation. I must agree, though, that at this time it's very difficult to beat inflation globally, and it's not just restricted to Nigeria. Again, because we are in a phase in the global economy where inflation is being caused by some cost push factors, and monetary policy authorities are using monetary tools to tackle them, and in the process you find more inflation resulting. So interest rate is no longer sufficient to fully curb the effects of inflation, and investors are looking for what can they get better just to make, things work. So this has really impacted on the investment management space, which is really growing. Perhaps this is what informed what the Securities and Exchange Commission then came up with around 2021 to start, looking closely at these privately managed funds as different from the mutual funds. The mutual funds are more or less, public because, they are unitized, but you're seeing, regulatory coverage for mostly private managed funds, which sometimes can be much more higher than even the mutual funds that you see that are, public. So it's still a growing space, and we're still going to see more of that. You could argue also that it's competing with the traditional banks because, most investment managers will now play in their space. Before now, people would take their funds to the banks for deposits, fixed deposit, as we call it, for specific tenors. But, because the banks offer that opportunity and it seems restricted, but for investment managers, it comes in different forms. You could have one, private portfolio that is targeted at some specific equities. You could see some that are focusing on some dollar assets, across different markets. So I think the ingenious, should I say, products that have surfaced on the back of the so-called privately managed portfolios is one of the factors that is driving that space, apart from the macroeconomic headwinds that people are trying to really tackle.
We had some returns up on our screen a moment ago. Our quarter to date, I think your dollar fund is doing well, Quarter to date, 1.8%, equity fund, 5.6%, your Plutus funds, 11.8%. How would you, as far as managed funds, looking at the quarterly performance with the first quarter behind us, how would you say the
well, for the funds, which are, public funds, by the way, they've not been immune from the different macro headwinds, facing the country as a whole and the global economy at large. So if you look at the dollar funds, for example, where we see 1.8% quarter to date, if we continue at that pace, it looks like the annualized return could, close the year at the run rate that you're seeing at something, shy of 8%, by the end of the year. Again, if you look at, and maybe because some of the ways these portfolios are managed, sometimes you have them held to maturity, as we say, as against following the market volatility. Because if I follow market volatility, it could be quite volatile up or down. But given that the portfolio is able to benefit from any market movement that you want to take advantage of, so you could actually see returns higher than that, by the time profits are taken in the course of the year. But the point I'm trying to make here is that these funds have been largely affected by what has happened globally in terms of market performance, and you can't forgive inflation for what it has caused for most of what we're seeing currently. So for the dollar fund, for example, even though you're seeing policy, should I say, the slower pace of interest rate hikes by US Fed, because we're talking about dollar funds, so whatever is happening in the US tend to affect it. The slower pace is there, but it seems like market is not sure yet whether Fed is able to fully contain inflation. So we're seeing market dragging, because market is not quite fully has not quite fully captured, so to speak, whether the efforts that have been put in by the Fed by raising interest rates is able to fully capture or put a rein on inflation. So that point is there. But okay, go on.
Yeah. By a minute and a half to go, I just wanted to know, as far as 2023 playing out, how do you think between the equity funds, FX? I feel, maybe people will go to FX because of the exchange rate pressure and to preserve purchasing power. But how do you think inflation, how do you think things will play out?
Well, I would think that as we go along this year, inflation will still be a very big issue to discuss, and to that extent, if you're really interested in beating inflation, then playing the equity space may be interesting for you.
Yeah.
And if you look at playing in the equity space, you have to also be guided on which part you want to play. Look at the NGX. NGX has done maybe about 5.8% quarter to date, year to date, as the case may be. But we have quite some sub-indices of the NGX, proudly. There is an AfroInvest High Dividend Yield Index, an AfroInvest Banking Value Index that have all surpassed the performance of the NGX. Maybe I think 8 and 7%. 8 and 9% respectively for those two indices. They are far better than what the NGX will offer. But that's in one quarter, remember. So if the performance is sustained, it means that you could see close to 36% by the end of the year.
That would be gorgeous.
And that would be would be so sweet in beating inflation, so to speak, which is already at 22%. Fixed income today may not be able to give you that, benefit, because there's this dislocation between monetary policy rate and the market interest rate. And that factor will continue to play out for the rest of the year.
We'll see how it goes. Robert Omotunde, always a pleasure having you with us. Chief Investment Officer, AfroInvest Asset Management. Thank you so much for your time.
Thank you.